problems. Look, I mean, generally, I'm taking a slightly different slant on it, I suppose, to what we've just been talking about, but generally speaking, you're going to be trading as a sole proprietor, so trading in your own name, or you're going to be trading as a company. You might have some other structure, there might be a trust structure there, but the trustee is going to be a person or it's going to be a company. So evidently, if you're trading in your own name, you're going to be personally liable for whatever the liabilities of the business happen to be. On the face of it, if you're trading through a company, you're not going to be personally liable, except for those things that you agree to be personally liable for. It might be a guarantee on a lease or on a loan. You might have some tax liabilities that you're going to be caught up with and be personally liable for, whether you like it or not, as a company director. But generally speaking, there's meant to be this separation between you and the company, and you're not going to pick up that personal liability. But that doesn't mean that you don't have to care about what happens with the company, because it's all alright. It's just what's happening to the company. It's not going to affect me. And doesn't mean you don't have to worry about your financial records and going over your books and that sort of thing. And one good example of that is if a company doesn't create and maintain its financial records, then a presumption that it's insolvent operates, and that won't matter while everything's just smooth sailing. But the problem then arises down the track, something goes wrong. The business has some trouble, perhaps a liquidator gets appointed, and then you've got trouble with the liquidator saying, well, you're presumed to have been insolvent for X amount of time. So the company might only have had trouble meeting its debts for, say, 12 months. But you might not have bothered with keeping your financial records for 4 years, and so all of a sudden you've got a presumption that you've been insolvent for the last 4 years. Well, how does that affect you? Well, it does in a few ways. I mean, firstly, the liquidator's going to be going back and checking your transactions from maybe 4 years ago. There might have been dividends paid, loans given, property disposed of, or whatever, and these might now all of a sudden be subject to the possibility of getting unwound and having a personal effect on you. Secondly, it increases the period over which you as a director might be personally liable for the company's debts. You might say, well, what's this? What personal liability are you talking about? Well, if you're a director, if you're causing the company to incur a debt at a time that it's insolvent, then you can the court can order that you compensate the company for the amount of that debt, so that the company's not out of pocket. Okay, so that's a real risk for you. Now, you might be able to rebut the presumption that the company wasn't insolvent, even though it didn't have its financial records. But that makes it a lot harder for you. So it's a good idea to keep your financial records going along the way. Putting aside this presumption that I've just mentioned, and generally the test as to whether a company is solvent or insolvent is whether it can pay its debts as and when they fall due, generally from its cash resources. So it's a cash test, it's not a balance sheet test. So you might say, look at your company and say, well, look, we've got an excess of assets over liabilities, therefore I'm not insolvent. That's not really the test. The question is, have you got enough liquidity there that you can pay your Synergy bill, your Telstra bill, as it comes in? Now, if you've got a temporary period of illiquidity, that's not necessarily a problem. So when it becomes endemic, that it's a real problem and you probably are insolvent. But that's just something that you really do need to watch out for. You do need to keep an eye on your figures. Are you actually profitable? What's the plan? What's the trend for the future? And really do keep an eye on it. Because sometimes these claims for insolvent trading, that you've been a director and you've caused the company to incur a debt when it's insolvent, they can be quite significant. Mainly, they're usually ATO debts. That's normally a big one, your BAS, which is your GST, your fringe benefits, your pay-as-you-go, also your superannuation guarantee. Sometimes ATO debts, they push you out into the hundreds of thousands. Also, you might get caught by something fairly simple. A family member might have loaned some money in. Family member probably doesn't care too much about being repaid. If the company goes belly up, the liquidator might step in and say, well, hang on, I'm going to force you, the director, to pay that money back into the company, and then I'm going to distribute it pro rata to all of the unsecured creditors, not just the poor old person, family member that's loaned it in. So you can be caught there, so you've got to be fairly careful. So I've got 4 tips for you. I mean, the first one is obviously create your financial records that adequately explain the financial position of the company. Just do it, even if it's just your small little company. You might as well just get in the habit, get started and do it.
How do you do that again? Sorry, just to interrupt.
Well, it's just a matter of making sure you've got something in paper that shows your money coming in, shows your money going out, that explains if there's loans and money moving around, sort of where it's going. Just so someone's got something there.
Yeah.
that explains that gives you an idea as to where your company's going. And this might just be your general management accounts.
Yes.
You might do some end of year financial accounts. No strict requirement to do that, but as long as when something happens and you've got the papers that you can hand over and you say it shows what all the main transactions are. A lot of people just don't worry about it. They just run the company as if it's their own bank account. They just take money in and out and don't really worry about recording it anywhere. So do that, create some sort of financial record. The second thing is keep it for 7 years from the date of the transaction. No good to keep it for 4 years or 5. Okay, the statutory time limit is 7 years for it, and I think that's the same normally for your taxes, 7 years as well. So it follows on with that. Third thing is get your BAS lodgements in on time. Give some preferential treatment to the ATO, and the reason why you do that is because some of your tax debts you can be personally liable for. Okay, your BAS lodgements. Number one, you have to get them in on time now, and then number two, if you don't pay your BAS lodgements, then you can, as a director, become personally liable for them. You have director penalty notices issued against you. So give the ATO. Normally the ATO gets left out, and that's why the legislation's changed a lot. So they've got much stronger powers now. So if anything, if you're going to prefer someone, prefer the ATO. At least in respect of the debts that you might become personally liable for. That's the third tip. And then the fourth one is just a general comment. What's your bottom line? Don't be afraid to speak to someone, particularly speak to an accounting person, and be useful, particularly if they've got insolvency background. There's a lot of them around, or alternatively speak to a lawyer with insolvency background if you've got any concerns about how your trading figures are going, or whether you might be at risk of insolvent trading or some sort of claim against you.